Welcome back to our video series on the creation of your course project. Hello, this is Lynn Chase, and welcome to this week's Business Organizations lecture. This week we will be discussing the topic of corporate financial structures, which you may use in the formation of your semester-long corporation creation project. The learning objective of this lesson will be to help you understand the sources of funding for corporations so that by the end of the lesson, you will be able to create a strategy to fund your new corporation with the use of stocks and bonds and include this strategy in the Articles of Incorporation. To begin the process, we must first understand some of the basic terminology regarding the sources of potential funding for your corporation. A security is a share, an agreement to participate or other interest in an enterprise of the issuer, or an obligation of the issuer, which could be an individual, a corporation, or a business entity. An equity security is a security representing an interest or share of ownership in the enterprise. Equity capital is money received in exchange for a share of ownership in the corporation. When this happens, we call the process the issuance of shares from the corporation to the new shareholder. A debt security is a security representing an obligation of the corporation or the entity to the lender. We call this document a bond. This bond is issued as evidence of the debt owed by the corporation to the bondholder. We commonly refer to this relationship as that of a borrower to a lender. A debt capital is money received by the corporation in return for the issuance of the bond or debt security. The difference between bondholders and stockholders is that bondholders receive interest on their loan to the corporation, while stockholders receive money called dividends from the income of the corporation. If there is no income, the stockholders generally do not receive and are not entitled to receive anything, while bondholders have a contractual right to receive monies from the corporation regardless of the income of the corporation. Corporations may typically issue two types of stock. They're referred to as common stock and preferred stock. When you prepare your stock certificates to provide to your investors, are going to issue either common or preferred stock, and you can issue either type. We call common stock ordinary stock because it carries no special privileges for the stockholder or obligations for the corporation, other than to distribute dividends when it determines that it's in the best interest of the corporation. Berkshire Hathaway is a famous American corporation that does not distribute dividends to its shareholders because it believes that by retaining the income and building the corporation, the value of the company will greatly benefit the shareholders by the stock value going up rather than by distributing funds to them. Preferred stock in a corporation carries certain privileges and benefits. An example might be the right to convert from preferred to common stock, or a priority on the distribution of funds. To better understand the differences between common and preferred stock, please review the following slides. You will notice that generally common stock has the right to vote on matters of the corporation, such as the election of individuals to the board of directors, while preferred stock does not have voting rights. As you can see, common stockholders cannot be paid dividends if the corporation is insolvent. This means that if the corporation cannot pay its bills as they become due, they cannot deplete the value of the corporation by distributing dividends. However, if a preferred stock is granted some annual distribution of dividends and does not receive those claims for dividends will accumulate so that when funds are available, the preferred stockholders will receive the monies that the corporation was unable to pay in prior years. Common stockholders are not entitled to this right. In the event that a corporation were to be liquidated, meaning the assets sold and the distribution to appropriate parties, common stockholders would be the last to be paid, and preferred stock shareholders would only be paid after the payment of all debts and obligations of the corporation, which typically includes bondholders. Finally, common shareholders do not include any right to conversion, while preferred stockholders may have rights to convert their preferred stock, but they may be forced to sell their preferred stock back to the corporation at a predetermined agreed upon price. Of course, the corporation could go into the market and purchase common stock, but the price of that is going to be determined by the market value at the time that the purchase is made, and you cannot force the common stockholders to sell stock back to the corporation at a predetermined value. Finally, a quick comparison of the difference between stockholders and bondholders is that stockholders own a part of the company, while bondholders do not own the business but are lenders. The more stock that a company issues, the less percentage of ownership exists for the prior shareholders, while bondholders, on the other hand, do not dilute the ownership percentage of the corporation. During a liquidation of the corporation, the treatment of bondholders is substantially different from stockholders. Bondholders have a priority, and unless and until they're paid, there can be no payment to the stockholders. Another substantial difference is that for tax purposes, payments made to bondholders are deductible from income and therefore can reduce the tax obligation of the corporation. However, income in the form of interest paid to these bondholders is, of course, taxable to the bondholders, but distributions made to the stockholders is taxed by the corporation and becomes income in the hands of the shareholders. To summarize the key features of the corporate finances, please remember that we're talking about methods in which corporations can raise the capital to begin operations or to expand, and how to best serve the interest of the shareholders as they grow and maintain their business. An important concept that should be incorporated into the Articles of Incorporation is a decision about the par value of the stocks. There must be a choice made as to whether there will be par value and what the par value will be. The par value is simply the lowest dollar amount required to purchase a share of the stock. If the corporation does not set a minimum value or par value for the issuance of its stock, the directors can determine whatever amount they believe is in the best interest of the corporation. This uncertainty could have a detrimental effect on the ability of the corporation to convince purchasers to buy the stock. The incorporators and the directors could also make decisions about the classes of stock to be issued and the benefits to be attached to the common and preferred shares. The decisions about par and no par value stock can result in unfair treatment if one group of purchasers is able to buy the stock for substantially less than other groups. In the example I present here, if the insiders can purchase the stock for $2 a share, but charge regular investors $20 a share, the investors will get the same benefits and the same dividends for paying substantially less. The concept of watered down stocks could prevent the corporation from attracting well-informed buyers. Another key feature is that benefits provided to preferred shareholders as opposed to common shareholders. It is possible to offer debt security holders collateral owned by the corporation so that in the event of a liquidation or a failure to pay the contractually agreed upon interest, the creditors may have the ability to take possession of the equipment and real estate owned by the corporation. As an additional inducement to convince lenders to provide capital to a corporation, they may be given conversion and redemption rights to other assets of the company. Depending upon the corporate financial strategy developed by you as you create your hypothetical company, you may want to consider the fact that interest payments to the bondholders are deductible from the corporate income and thus reduce the corporation taxes. As you proceed on the creation of your corporation, these concepts regarding debt and equity as recognized by your choice in the issuance of stock is important because you need to make a mixture perhaps of the sale of stock and the issuance of bonds, because that will have a huge impact upon your future success. Thank you and good luck as you continue to build your corporation.